Morning, everyone. It's a pleasure to be here in Prague, and I would like to thank the organization for putting this together. Sorry, my Czech is a bit poor, so I'll do that in English. I think you will understand much better. So this is so my plan here is to sketch out some recent work on macroeconomics on insolvency. And then I'll dive into a particular piece of work which I think will be of interest to some of you, in that it deals with the process of restructuring, negotiation over debt, and settlements of debts. So let me start with part one. I'll just outline some thoughts about what's been going on in macroeconomics. So I'll jump very quickly over these slides, only to say that over, say, the last 10 years, there has been considerable progress in macroeconomics research in the field of relating to insolvency and bankruptcy in particular. So here's just a bunch of papers. Only to say that this stream of work takes fairly seriously the institutional detail. And I think this is something that you agree is important, to be careful about how the bankruptcy code is designed, what are the protocols that somehow inform the process of negotiation over debt. And so this is uncharacteristically perhaps of macroeconomics, this is a fine attention to detail. Now, the work has been mostly focused on the US and on household and small business debt. Yeah, but I'll have some words later for further work, perhaps involving corporate debt in the future. Okay, so this against a background where in the US there is a bankruptcy code where essentially individuals and firms can discharge their debts at some cost. And they face some cost, and there are also some assets that can be taken away to a degree depending on the exemption level. They're having some recent changes. The last Bankruptcy Reform Act somehow became less friendly to debtors, make it harder to go through the process of bankruptcy and clearing debts. There have been some changes in credit market regulation, somehow being tougher with lenders. And this is against about the drop of a rising incidence of bankruptcy and debt since the early 70s. So this picture only shows that there has been a sustained increase in bankruptcy rates in terms of people filing for bankruptcy, at the same time as there has been this sustained rise in levels of debt. So in terms of bankruptcy rates, about 1% of the population sample of the US has filed for bankruptcy within a year. Then we'll talk about delinquent loans later. This is a more recent picture showing developments in bankruptcies more recently. Here, this is a spike. This is just before the reform. As I said, there was this reform in 2005, which became much tougher for debtors. Of course, everyone rushed right before this regulation came into effect to file for bankruptcy, because after that, that will be tougher. So, and then there was this big sharp drop afterwards, but things are leveling off and seem to increase during the recent crisis. Okay, so this is the backdrop, and somehow these are the type of questions that this research tries to address. One would be the obvious one: why there has been this increase in bankruptcies and at the same time as debt? Because you might think that, well, it may strike you as surprising that, given that people seem to be more inclined to default, not to pay back debts, how is it that lenders still seem to be willing to extend debt and therefore underpin that increase in levels of debt? And so, ideas why this may have happened. Well, perhaps it has to do with this increasing inequality in the US. So poorer households have become poorer, so less able to meet payments. Perhaps the social stigma of being bankrupt somehow has been mitigated. It's more acceptable to be bankrupt. Perhaps there has been something going on with the costs of medical expenses or the costs associated with divorces that hit households, and because we know that a lot of bankruptcies have to do with these sort of big items, health, medical expenditures, and other disruptions to families. So this is one type of questions. Another type of questions is, what about policies? What are the policies that, given that people sometimes don't pay debts, what are the policies that may deal with this? Perhaps trying to find what sort of interventions, perhaps changing the means test requirements to file for bankruptcy, perhaps changing the exemption level. May have an effect on welfare of consumers. Well, so the approach in this research is, okay, so basically we take theoretical models with an aim of implementing those models with the data, using those models somehow under the discipline of empirical evidence. Well, the first thing is to recognize in these models that there's a lack of commitment to pay back debts. So we break one of the classical assumptions of neoclassical analysis. And then we assume that some realistic features of financial markets, the markets are incomplete. Well, so what incomplete markets means is that, well, markets are not complete. So in an ideal world with complete markets, basically you would be able to write contracts that prescribe that you pay your debts only if things go well, if you are doing well and your income is fine. But when things turn sour, when in periods of difficulties, you won't pay back debts. And actually, you might write contracts that pay you something back in times of difficulties. That would be a world where markets are complete and there is full insurance and people can insure. Well, this is not the reality. So we have to study models where markets are incomplete in the sense that people sign standard debt contracts. Well, basically, you assume a debt and you know that you will have to pay, or you make a promise to pay whether things go well or not. So. And this is an important financial friction in these models. And then we also have to recognize that not everyone looks the same. And so we have households of many different types in terms of wealth, income, in terms of other characteristics. So here we therefore, well, and the idea is that we know that many policy changes do not affect everyone in the same way. There will be losers and winners to policy changes, and therefore we have to take seriously this heterogeneity. Again, this somehow deals with the usual discredit of macroeconomics as a discipline that only deals with a representative agent. That's not true, at least in this field of research. Okay, so some answers to the questions. For example, when we ask the question of what's been driving increasing default rates and debt, well, it seems that quantitatively, through the lens of this type of analysis, developments in technology for credit have been important. The fact that creditors have been able to splice, to design contracts for different types of agents somehow has democratized credit. So households that before didn't have access to credit, now they do, because banks are able to design contracts that perhaps with higher interest rates and harsher conditions for households that are riskier. Whereas before, when there was not an ability to follow up individual types or to design contracts according to individual characteristics, that was harder, and therefore many households would get excluded for that. So credit democratization, this seems to have been driven, to be behind these developments in debt. In terms of policies, well, a message that comes from this literature is that a stricter bankruptcy code actually is good. To be less friendly to debtors somehow seems to be beneficial. And the back of this is the idea that if you make bankruptcy tougher, and you will make lenders happier to lend in the first place. So you will improve access to credit to everyone. Otherwise, if the bankruptcy code is very lenient, banks will be very cautious, and before giving a loan, they will look very hard, and therefore that would exclude from credit many people that would be deserving that. And so that's this. So let me move on to the second part, because as I've said, this literature has been dealing with formal bankruptcy, basically process of bankruptcy, but there is a lot of insolvency or default that happens through informal means. And this is what this paper, which is in collaboration with one of my colleagues at Buffalo, but also involves other people, we are trying to deal with. Well, this is just a picture to show that there is a lot of informal default or delinquency. These are loans these are debts that are behind in payments, but haven't led to a formal bankruptcy filing. Well, we see that quantitatively, as we said that about 1% of people declare bankruptcy. The number of people engaged in delinquent loans is several-fold larger than that. So it's worth having a look and trying to understand this process. So that motivates the study. And the idea that whereas formal default prescribes, is highly prescriptive as to how debts are settled, so there's not much room for negotiation, at least in the US, or as a first approach. In informal default, there is strong evidence that when there are delinquent loans, the first thing that banks and debtors do is try to talk and to come to an understanding and to settlement. So we look at informal default as a process that involves negotiations. So the gist of this paper is to try to understand how negotiations develop and what are the outcomes from those negotiations and whether they bear some bearing with actual data. So basically what I'll focus today and for the rest of the talk is to see whether this type of model, well, just to show that this model, that the model that we develop as a first approach, it's always a first step, seems to be sensible quantitatively, so it's somehow reliable to some extent. And then we'll conduct a few policy experiments and document some implications of these policy experiments in this type of lab economy, and with a focus on recovery rates, what these policy changes imply for recovery rates. So let me just, this is just a highlight of the results. Basically, we'll see, well, we have a model that in principle seems to be reasonable to start thinking about policy questions. And then when we analyze policy questions, well, we consider a number of them. For example, measures that tend to facilitate negotiations will tend to improve welfare. We are thinking this about the welfare of the economy overall, not only welfare of lenders. That there are some consequences from changing exemption levels, and also we'll look at the consequences from debt collection, and the ability of debtors to pursue debts and chase debtors. Well, the bottom line will be that policies that increase social welfare in a way are policies that are also associated with improved recovery rates, which may be reassuring. Again, there will be some caveats on this, and we have to be cautious when we take that to policy, because it's just baby steps that we are taking on a complex issue. But as since preliminary results suggest that. So let me talk to you about how we think about these things. So how much? 10 minutes. Okay. So let me just give you some elements of the model, the theoretical model, and then we'll move on to the implications. So in these models, basically the focus is on the interactions between the two types of groups of agents: households, consumers, in this case, and lenders, financial intermediaries. Well, the main point is that households live in a world where they save, and so they build assets, and they may have to borrow because they face shocks to income. They may lose a job, they may be hit by medical expense, unforeseen medical expense. So they use financial markets, and so they save, for a rainy day, but sometimes that's not enough, your savings are not enough, or perhaps may not be worth to deplete your assets, and you may then use financial markets and borrow there. Yeah. Then on the other hand, there are lenders. And lenders, lend money and they expect to be paid back. Now, this may not happen. Under bankruptcy, basically they will see a loss, typically, up to basically the level of assets exempt. But then when there are negotiations, so there may be bankruptcy, but in other cases the people may engage in negotiations and try to work something out. Well, in these situations, the lender will offer a settlement plan. And then negotiations start from there. And so let me then look at basically how these two types of agents interact. Well, they interact first through markets, through standard credit markets where they borrow and lend. And as I said, agents will be able, as it seems reasonable for the US, to tailor contracts and to set interest rates for different types of agents, depending on how much they borrow and depending on the asset position of those agents and also their income status. And this is the classical interaction in markets. Just issue debts and borrow on the part of consumers. Now, as we said, these agents may interact outside of the market when there is a failure to repay debts. As we said, well, the first instance is bankruptcy. And bankruptcy, as I said, here we model bankruptcy as a process whereby debts get discharged, but creditors may seize some of the assets held by the household. That seems congruent with the US system. Now, alternatively, they could decide and try to bargain. And perhaps bankruptcy is not convenient for neither part, and they may decide to negotiate. And negotiations basically imply that they see the bank proposes, okay, you pay me back this much, and if you are willing to pay me back, you will regain access to market. So part of this settlement may involve new issues of debt. And this, again, seems to be coherent with the practice in the US. So let me skip this, only to say that basically when we work out these models, in the end, the object of interest would be, well, this will deliver a distribution of people over asset positions, over levels of debt, over income levels, over credit status. And then we'll also characterize what are the decisions that these agents make in the market and when they are negotiating. And basically what we'll use is this distribution of the population that is delivered by the model to perform policy analysis, to compute the statistics and see how these statistics feature up against the data and how they will change when we make policy changes. So let me only to say basically that methodologically, what we do is to build this economy by calibrating. This means we choose somehow, we try to feed the model to the data in a certain way. Well, in particular, what we do is to try to feed the model to aggregate measures of debt, of portfolios, and in the credit market. And then we do some, basically, well, I don't want to dwell on this table, only to say that basically we have many different types of agents. We have agents that declare formal bankruptcy, agents that decide to not to pay but engage in negotiations, and then whether they engage in negotiations, they may reach a settlement or not. So we have basically a description of what are the characteristics of all these agents in this type of economy. Let me skip this, which is about the mechanisms. Perhaps only just to spend a few moments on this one, because this tells us about recovery rates. So this is a picture that gives us on the plane, describes the level of assets and levels of debt of individuals, and this is, and these two pictures are drawn for a typical low-income agent and a typical high-income agent. And this curve, what gives is recovery rates, the percentage of debt that is recovered under negotiations. Well, and what it says simply is that, well, recovery is higher on households that have a higher level of assets, and then drops quickly as assets are poorer in terms of assets. And also recovery rates are higher at lower levels of debt than at higher levels of debt generally. And this perhaps describes a bit the trade-off and the difficult choice that lenders have to make when they propose a negotiation plan. And in terms of delay of this, with which this settlement is reached. And it is that if you try to settle too early, actually you may not recover much, because levels of debt are high, and perhaps this is an impoverished household. But if you wait too much, actually recovery rates could be worse. I mean, the idea is that you may wait in the expectation that the financial position of the household improves, and then you will be able to reach an agreement on which the lender recovers more of what was lent. But in the meantime, while a settlement is not reached, the household may deplete their assets and make recovery harder later. So basically, this is the trade-off that governs and determines how long it will take for a settlement to be reached. And somehow this picture underlines that. So let me then move on. Well, this only is to show you that we have carried out some validation exercises with this model, for example, to see whether this model somehow is consistent with the portfolio compositions of households who make different default decisions, of those households that go bankrupt or those households that negotiate, and the model seems to be doing a good job. So given that we think that this is in principle reliable, we conduct some policy experiments. We have conducted a number of policy experiments since we are running out of time, I believe. How much? 4 minutes? Let me perhaps jump to an experiment, policy experiment on this model. And what we do here is, well, this experiment, probably I didn't say that, we assume that while a settlement is not reached in negotiations, creditors can go after debtors and grab some of their outstanding debts through various means, perhaps harassing them over the phone, knocking at their door. Well, they can do that, and then recover part of their debts through those means. Now, we consider a change in regulation somehow that makes this collection more effective, somehow that facilitates these collection activities on the part of debtors, which in principle you would think, well, is a form of sorry, I said, what I meant to say is that this is a situation that makes it harder to collect debts through those means. That's the direction of the policy change. So in principle, it would be more consumer-friendly. And you have your debts, and you are not harassed that often and to that extent as before. And somehow, the amount of money that creditors can obtain through collection means is reduced, and perhaps this is related to a change in regulation that restricts debtors. So let's see what are the effects of this. Well, what we see in the first place is that since debtors see their ability to pursue debts narrowed, they will become more cautious when it comes to extend new credit. So there will be a reduced access to credit. And as a consequence, this drives a reduction in overall welfare in the economy. And the point is, debtors will lose their ability to collect debts through through informal means. So those creditors will be less willing to extend credit in the same place. And this hurts the economy, because we said consumers rely oftentimes on debt, on borrowing, to deal with financial difficulties, with adversity. If credit is cut, so there's a credit crunch, in a way, that leads to worse welfare outcomes. Of course, some households benefit from that, these restrictions. Those who are already delinquent, that are behind in payments, they somehow are protected. But on balance, overwhelmingly, the effect on consumers' welfare overall is negative. And this measure, of course, goes alongside a reduction in recovery rates. Why? Well, debtors know that they are not going to be bothered so much about repaying their debts. So when they bargain over debts, they have a stronger negotiation position. Because, well, if we don't reach a settlement, I don't mind so much as a borrower, as a debtor, because I know that you won't be knocking on my door. And therefore, this means that when negotiations take place, then the amount of repayment on settlements will be less than that. And basically, these pictures or these tables reflect a bit this. Basically, this last column in this bottom table reflects that this policy change leads to a reduction in recovery rates, both for those debtors that just defaulted in the current period, and also for debtors that have a history of attempted negotiations and failed negotiations in this case. So this is an example of a situation where policies that actually hurt in terms of welfare are associated with also worse outcomes in terms of recovery. And as I anticipated before, this applies to other policy measures. I'll just show you to finalize some pictures showing that in terms of recovery rates. This is the same picture that I showed you earlier for the benchmark economy, but this is after the change in policy. As you see, recovery rates are dropping much faster with levels of debt and with levels of assets. And this underlines that figure, those summary statistics related to recovery rates. Similarly, this is the picture that depicts the welfare gains from this policy. And again, this is over the space of income, low income on the left and high income on the right, and over debts and asset positions. What we see is that generally, as we said, there are people who gain and people who lose out from those policies. Okay, so those who gain are those with higher levels of debt. But there is the big mass of people that normally sit on this region of the wealth distribution that are losing out. And this is what is driving the overall negative consequences of that. And as I said, it's important to understand that behind these negative welfare effects is the behavior of credit access, in other words, of interest rates. And this final picture shows what's the change in interest rates when this policy takes place. And what this is showing is the inverse of the interest rate, basically the price of bonds, debt bonds. And this going down means that interest rates go up. So what this says is that at all levels for all types of individuals, interest rates increase a lot. So in a way, credit is more restricted, and this is what underlies the negative effect of this policy. Well, this is only an example of a policy change, but this type of logic and analysis underlies this basic prediction that recovery rates, but policies that somehow improve welfare are associated with better recovery rates. However, we have to be cautious because there are many assumptions. Of course, we're working with models, and these models make sometimes stark assumptions. We have to try to think seriously about our model of risk pricing as well, and perhaps to introduce more realistic features like long-term contracts, and perhaps issues of information, which we believe might go against this idea that improving recovery rates is always good for everyone. Although so far the result seems to be this one. And then just finally some further thoughts for the future. There's a lot of work to be done in this area. It's very exciting, but it's still in its infancy. One thing that is long overdue is a focus on corporate insolvency. I think that we can do that because somehow the analysis that we have developed in this paper and in other papers seems to be preparing the ground for this type of analysis. Since we know that in corporate bankruptcies, there's a lot of negotiation going on, so this type of models could be extended to that area. And as well, we have some work with my colleagues in Minnesota over long-term credit lines. Credit lines are important for corporate finance, and therefore, somehow, we should be ready to start working on corporate finance, on corporate insolvencies very soon, I guess. Thank you. I'll leave it there.